Hello and welcome to a brand new episode of Smart Money. Now, since it is the start of a new fiscal, we thought that we should put together a plan for you to invest into 5 or 6 important products that you need to have in your portfolio. Of course, these could be the same old products, but it is never too late to revisit old and classic concepts. So our expert today is Anand Dalmia, who is the co-founder and chief business officer at Fisdom. Prior to that, he was with UBS for a while as well. Anand, thank you so much for joining us. And he has been a regular on our channel too. Anand, there are 5 or 6 products that you're going to talk about. So let's get straight to it. Mutual funds, right? Just want to start with that. In FY24, how are we placed? Because this has been a very challenging year. Any investor you speak to will say the last 3 years my returns have been subpar and, really nothing to speak about. Yep. So is it still a good time?
Look, I think, to invest in mutual funds any time is a good time. Yeah. It all depends on what your purpose is. So, if you look at the majority of the investors, they invested in balanced advantage funds. And the reason they've not made returns is because that portion of the balanced advantage funds didn't actually make the returns, right? So we generally tell our investors that be there for 5 years or more. And I think while the debate is out, whether active versus passive, we still believe that, mutual fund is probably the most tax efficient manner to make the best returns. Now, the categories that people choose depends on their risk profile, but the simplest categories are the multi-asset, the flexi cap, and the balance advantage. I would say people should get into it depending on what their risk profile is. Secondly, I would say we should follow some fundamental principles. Like, we keep talking about diversification, asset allocation, and don't do everything at a go. So don't put all your money at a go. So what I mean by that is try and do an SIP, or if you have a lump sum, then try and do it in an asset allocation fashion, rather than say, okay, I'll do it in equity and then I'm looking at returns on a daily basis.
Okay. So you know what, in this day and age of like Google and Google Maps and AI and ChatGPT, people want all their work to be done for them, right? So we keep getting queries about what we should invest in terms of mutual funds. Which are the funds to invest in? Don't just tell us invest, but tell us the name of the funds. So if you had to pick out 2 or 3 mutual funds that one can look at, perhaps for the next 1 to 2 years, which ones would they be and why?
Look, 1 to 2 years is a slightly difficult one because we just generally tell people invest for a longer period of time. I would say on the balance advantage, again, the category, if you want an asset allocation, balance advantage, we like ICICI Pru balance advantage a lot. Multi-asset is something very interesting now that people want a bit of gold also there. So, if you want debt, equity and gold, go for multi-asset. I think we like the SBI multi-asset fund a lot. And my personal favorite for people who want to invest in SIPs is, and if they want diversification, is the flexi cap category. Within that, we like Parag Parak because it also has got an international flavor to it. And we also like the Kotak flexi cap.
But the issue with the Parag Parak International Fund is, right? I mean, it's underperformed so much. It's caused a lot of frustration to investors, especially after what's happened with big tech stocks in the US. You still like that fund?
Look, I am a big bull on NASDAQ per se. I generally believe that, look, it's a great time. If you look at Facebook 3 months down the line, or 3 months earlier, I would say, it's almost moved up 100%, or Meta as we call it now. So I believe that tech is going to come back. Obviously because of the cost of funds, I think tech has taken a beating. But last 3-4 months, NASDAQ has recovered almost 30%. So to get a flavor of it, to make sure that if it was to come back and you want to create that alpha, I would say Parag Parak and international equities is a good 15% that you should invest in.
Okay, so that's about mutual funds, and we'll come to that in a bit. But I believe one of the most underrated and effective ways or products to invest in is the National Pension Scheme.
Absolutely.
So for people who have not invested yet, tell us about that.
Look, as a salaried employee, most of us don't have a way to save tax, right? So the 180C that we always invested in is like 1.5 lakhs forever. And you've exhausted it through your housing loans, through your PPF, through your insurance products. There's something that people don't know beyond that. It is National Pension Scheme. So under 80CCD, you can invest additional 50,000 on which you've saved tax. Secondly, just like a mutual fund, and the cost of the fund is the lowest. So if you are more equity oriented, you can choose 60-65% equity, the rest debt. If you're more debt oriented, you can choose a more debt one. So there are 8 players there. We like HDFC, followed by SBI on the equity side. We like LIC on the debt side. So anyone and everyone who wants to save some more tax, the government has given us 50,000 rupees more. While it's not a lot of money, but I still believe that if you're, as it is going to invest, why not invest in NPS? and make superior returns as well as save some tax.
So, that we have that on our big wall and you can look at it there as well. So, the National Pension Scheme is what we're talking about. On the equity side, Anand likes HDFC and SBI. On the debt side, LIC. But assuming that a large part of our audience is between the age of 30 and 40, if someone has a high risk appetite, do you suggest that even within the NPS, it's better to keep a higher allocation towards equity?
Absolutely. See, unlike mutual funds, you can't get out of NPS till the age of 60. Given that you are investing for the long term, I think equity should be where all your money should be. Now, there's no option to invest 100% in equity in NPS, but you should go for the maximum allocation.
So, if I'm investing in equity mutual funds, then what is the difference between the NPS and an equity mutual fund?
I would say two fundamental differences. The first is the fact that you get a tax benefit out of it, which you don't get in mutual funds. The second is the expense ratio of this fund is lower than any direct equity fund as well. So this is like 10 bips is the expense ratio. So it flows to you, so you make more money.
Okay, great. So that's the National Pension Scheme. Got it. The third investment product is direct equity. Now, by this you're referring to buying stocks directly, right?
Yeah.
So in that context, how do you do it? Wouldn't you rather advise just investing in an ETF or an index fund rather than, breaking your head over which stock to buy?
Look, all of us think we are experts, right?
Yeah.
And there's a lot of products that we consume and we believe that, look, this is something that I want to do. And today with the advent of internet, I think, we have an opportunity to learn a lot. Like we have this 1% Academy and we see so many people coming in, enrolling for the courses. There are influencers that people are following. And it gives you a certain thrill to say that I have selected this stock and I have made these returns. So I would say, look, if you're not an expert, it's like if you want to fly, you can be the passenger or the pilot. But if you feel that you can be the pilot, then go for direct equities. Within direct equities, if you are a starter, right, where do I start? Then follow what Warren Buffett does. Things that I use on a daily basis and are part of large cap category. Like if I were to start someone, I don't know equity, I will probably go for a Unilever. I'll go for a Bharti or a Reliance.
But does that hold even today? I mean, look at the examples, right? Look, on a daily basis, what do you use? You use Dabur's products, say, for example, Marico's products. But these stocks have been underperforming for years. Something like, say, a Maruti. Of course, you see every second car on the road is a Maruti, but there are a lot of challenges that the sector is facing. So does that still hold that you should buy stocks, based on things you use on a daily basis?
Look, we are a big proponent of passive investing, that if you're not an expert, go for a mutual fund, go for an ETF. But, as I said, people want to try after they've seen some returns, they want to try equities. So if you are not an expert, I still would say that don't try direct equities. But if you have a craving to try it, then do the hard work or follow someone that you feel is the expert. Within that, rather than trying to find the next 20x or 100x, start with a large cap so that you are not disheartened, in a year's time. So I would still say that, look, these companies are great companies. You may lose some money, when you invest for the short period of time. The fundamental principle that if I invest in equities, I have to do it for a period of 5 years still exists. Okay. So if you invest in equities, we do it. However, the NSE data is very different, right? It shows that 99% is option traders, and we see a lot of people option trading. That is something that we don't suggest, that if you're not an expert, don't even try that. But direct equities for the long term in blue chip companies, you can seldom go wrong.
Okay. So, I'm glad you said you're passionate or you prefer passive funds. Because this is an argument that I've had with every expert, right? I am a big proponent of passive funds. I think I always believe, why should you put all your eggs in one basket? Why should you give one fund manager your money where there's a human bias, there is a familiarity bias, there's so many things. Rather than that, just invest in a passive fund, a nifty ETF. And a disclaimer here that I put a lot of my own salary into passive funds itself. But then what is the deal with active funds? I mean, do you still go there or do you avoid it entirely for the long run?
Look, the jury is out. It's about what creates alpha, right? Yeah. There's a set of active funds which still do it, but a lot of them have not done it. And that's the reason we say, okay,
I think 90% of active funds don't deliver alpha, and we know it, right?
Look, if you go through cycles, people believe that it can happen. Yeah. It's just so happened that it has not happened so much in the last few years. Having said that, I still believe that there are a lot of these stocks which are not still discovered in India. The job of a fund manager or an analyst is to find such companies. And that's the reason, generally as a large cap category, I would say the passive funds are better. But if you want to try the mid cap and the small cap, that's where you try for an active fund. But if you just want large cap, I think it's more of a reflection of Nifty then, it's very difficult for a fund manager to beat or, the index. So the cost of it, today, most of these large cap funds have a 1.5 to 2% expense ratio. So, it's difficult to beat the index by 2% year on year. I would say that, I'm on the same board as you. I would say go for passive funds. But if you want to try small cap, today the best way to go for is a active mutual fund.
Okay, for small caps and mid caps, if you have the risk appetite, right?
Absolutely.
In the large cap universe, there are anyway just a handful of stocks that generate returns. You'd rather invest in passive funds. Got that. Very interesting conversation. We're talking about all the products that you need to invest into in this new fiscal year. We'll take a quick break. Don't go anywhere. We'll also try and address some of your queries that have started to pour in. Stay tuned. Welcome back to Smart Money on CNBC-TV18. Very exciting topic. I mean, it's perhaps, old wine packaged in a new bottle, but these are investment products that you need to have in your portfolio. And if you don't, Anand Dalmia is here to tell us about that. Anand, before the break, we were talking about a couple of products, right? Whether it's mutual funds, direct equity, or the NPS scheme, National Pension Scheme. Tell us a little bit about corporate fixed deposits and bonds as an investment product, because this is a space which a lot of people don't understand. But now with the way interest rates are rising, what is the potential here?
Look, I would say, this is a great time to invest in any debt product. And within the debt product category, there are two types of risk. There's a liquidity risk and there's a credit risk. The credit risk is basically if you invest in something and you don't get it back. That's the reason we like fixed deposits of banks. Now, fixed deposit of banks generally give you a certain deposit rate. Now, if you take a bond, for example, central government, state governments, companies issue bonds. Now, if you buy a bond of a credible company, company is suppose something backed like by a state government, and you make a 8 to 9% on that for 2 years, we all know that interest rate is peaking out. It's a matter of time when the cycle turns around. So you get both the coupon plus the upside because now the interest rate comes down. So we believe that if someone is holding on to a good bond for the next 3 years, he can end up making 12 to 13% returns because it's a coupon. Plus, when the interest rate goes down, the prices of the bonds actually go up. So it's a great time to invest in good bonds. We generally suggest central government and state government bonds because the credit risk is not there. On the corporate FD side, it's again, if you can find AA plus or AAA rated corporate FDs.
Some examples?
Your Bajaj, or Shriram Transport. People have invested in the FDs over a period of time. They have a track record. And when you invest in these FDs, you tend to make 1% more than some of the FDs offered by banks. Today, you have a few small finance banks that offer you better FD returns. But if you're not too comfortable, you can go till 5 lakhs because till 5 lakhs, you have the insurance on that. So depending on your tenure, if your tenure is less than, say, 3 years, you should not invest in equities.
So you're saying that if you have a certain amount that you want to not invest in equities, rather than parking them in fixed deposits, you'd rather put them in corporate FDs?
You can put a part of it because, again, when you start doing it from on a day, if you're all FDs, you should not shift everything on a day. But a part of it, you can put it in corporate FDs to make higher returns. Again, go after the quality. Because sometimes, there are corporate FDs that you can make 12% returns. But the reason they're giving you 12% is there's a risk associated with it.
Absolutely. So you said Bajaj Finance, there's Shriram Transport, and which else?
Chola, Chola. So some of these guys, Sundaram also has a decent corporate fixed deposit.
And what returns do they give you over, say, a year?
Generally in the range of 8.5 to 9.5. So that's the range. And I think, there's a good track record for these NBFCs. And, and they've been deposit taking NBFCs for a period of time. They've not defaulted. So someone can look at these. Within that, we like Bajaj the most. I think it's the most stable company. But I would personally say if someone has access to bonds, because generally you need a minimum 10 lakh rupees check to have access to these bonds, the bonds market. So if you can do that, today bonds can probably give you the highest returns, given that, we believe that we are somewhere around the peak of the interest rate cycle.
Okay, that's very well explained. Lastly, the focus is on insurance as an investment product. Now, we can do a whole half hour on this, but just to crystallize it for us, term insurance is one thing, then medical insurance is the other. But, for someone who perhaps has not started their journey yet and not invested in insurance, what are the first 1 or 2 steps that need to take?
Look, as a principle, we don't think insurance is an investment product.
Absolutely.
Go for a mutual fund or go for a bond and take a term insurance. But, there's a tax element there. So, as you know, in the recent budget, if you invest more than 5 lakhs in an investment insurance product, it becomes taxable. But since you're just starting out, and because insurance returns are tax-free till 5 lakhs, starting this financial year, I would say someone can look at an assured return product. So the likes of HDFC, ICICI, all these providers have an assured return product. I would say someone should do that. But again, try and not mix insurance and investment. I would say go for a term insurance and look at the right investment product. You'll make a lot more money. But if you want to have that assurance and ride the tax benefit, go for a assured return product.
Okay, we're getting a lot of queries from our viewers. So we've tried to sort of put together a couple of them. The first query will come up for you on your screen in a bit. It's coming in from Varun Vedya. He says, can we expect a 9 to 10% returns from equities this year? Or is it a better option to opt for fixed deposits, which are giving us 7% plus risk-free returns? So this is equities versus fixed deposit. But of course, that 7% plus, you need to calculate that post-tax returns are much less than that. So what's your view here?
Look, it is, again, for a 1 year period, I don't think equities is a good product anyways, because while India over a period of time, I believe for the next 5 years, one can assume 12% plus returns. It's very difficult for anyone to predict what will happen between now and 31st March of next year. So if your tenure is just that period, I would say don't touch equities, go for FDs. But if you are looking at a rolling return, saying that, okay, can I make 12% rolling return if I invest today? Absolutely. Go for equities if you have a slightly longer tenure.
Longer horizon. But even within FDs, right? I mean, 7%, you have to pay tax on that. So it's better to go in for corporate FDs in that case.
So I would say corporate FDs or arbitrage funds. We believe that, look, if you have money for 3 months, 6 months, today you can put in arbitrage funds, because arbitrage funds are treated as equity funds. So you make a long-term capital gains on that or a short-term capital gains on that if you hold it for less than a year. And if your tax rate is 40% or 30%, you will make a lot more money in arbitrage fund than a corporate FD as well.
Okay, got it. Well, there's another query that's coming in, so I'll just request my director to get it on board in a bit. It's from Nilesh Khandelwal. He writes into us, does it make sense to invest in corporate bonds or Government of India bonds as advantage of mutual fund taxation is no more available?
Actually, I believe in this. We were just discussing this. Mutual funds earlier were more attractive just because of the indexation benefit and the taxation status to it. Today, given that that's gone, I would say it's much better to invest in a corporate bond or a government bond. And as I said, given where we are in an interest rate cycle, I think you can have a double upside. One is the coupon, plus, the benefit that will accrue to you if interest rates were to come down, which looks from the cycle and, the long-term yield curve that, it should come down.
Okay, and if you have, say, 100 rupees, right, what is the split between mutual funds and corporate bonds?
I would say it depends on your asset allocation. Generally we say 100 minus your age should be your asset allocation as a rule of thumb. So if you have 100 rupees and you are 40 years old, then 60% equities, 40% debt. So it should be equities and 40% in corporate bonds. Again, it depends on, for how long your money is there. So if you have this money for less than 3 years, then 100% corporate bonds and no equities.
Okay, there's another query that's coming in. I don't know if we have it on board, but it's, okay, there it is. Manthan Kashyap has written to us, what's your view on liqui loan products? It's backed by the RBI and giving returns in the range of 8 to 10.5% for a tenure of 1 to 3 years. There is another query that had come in on P2P lending platforms like Cred that are offering 9% per annum. So this is, I guess, liqui loan products are more about like P2P products, right?
Absolutely.
These are pretty risky in my opinion, but your thoughts?
Look, it is, I would say, if your risk profile is that high, go for equity. It's as simple as that, because in your P2P lending, you don't know the other party at all. You don't know the counterparty risk. You are basically assuming that, okay, a lot of people are there and maybe I get my money back. So I keep saying that, look, if you have the risk appetite, go for equity rather than debt, because your upside is limited, but your downside is unlimited. So might as well go for equity. So
basically the P2P lending is non-secured lending, right? It is to small ticket borrowers. There's a large pool of borrowers with unsecured loans. So it is in essence a very, very risky product.
It is.
Then why does it generate so much interest?
It just generates interest because, the people on both sides are actually individuals. One who has money, he believes that if I give it in a fixed deposit, I make 7%. But, there is a guy who's taking a credit card loan at 36%. He comes and takes at 15%. You basically, lend it to someone at 15%. But the point that we're missing is that, look, if that guy defaults, you feel that I'm now lending to multiple people. So people have said that, okay, your loan or your investment is across 100 loans. But what if 50 go bad? So you have no visibility into it. I think some of these platforms are doing a good job of using analytics. But at the end of the day, it's a very risky product.
Okay, guys, P2P lending is a very risky product, so don't even take a chance with it. And finally, let's end with gold, because this week gold hit an all-time high of 61,400, and there's so much FOMO. A lot of investors have written to me. Is it still good to buy gold, or have we missed the bus?
Look, given the volatility in the market, the macroeconomic situation, I think gold should be a part of your portfolio at all points of time. Generally, we recommend 10 to 15% of your portfolio should be gold. Within gold, today the best product is probably the sovereign gold bonds. So if you can buy that and make that 10% of your portfolio, it's great. If it's already there, I don't think, I would say you missed the bus, because, I don't think it's going to give the same returns for the next few years. On a rolling return basis, gold has not beaten equities in the last 10 years.
Okay, well, on that note, Anand, thank you so much for stopping by and speaking to us about the products one needs to look at. Of course, these are concepts that perhaps everyone knows, but there's no harm in revisiting classic concepts to help you with, your building your corpus. With that, it's a wrap on this special edition of Smart Money. Thanks a lot for watching. You can keep writing to us. See you again next week.